Welcome back, everyone, to Vox Markets. My name is Paul Hurl. I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott to discuss all things small caps. So welcome, Paul.
Thanks, Paul. Hello, everyone, and hope you had a nice holiday, Paul.
Yeah, no, it was fabulous. So we were away for 5 days. We had 4 days of nice sunshine, and then absolutely tipped down at the end. But can't complain because that's British weather, isn't it? So it's pretty
good for British weather, isn't it?
I know, yeah. But unfortunately, I did miss the Mello conference this time. It was just a different week. But I don't suppose you could just say a few words about the general mood and the observations of the 2 days, sort of like investor meter down at Chiswick.
Yeah, it was great. Sorry about I've got reflections in my glasses. It's distracting me a bit, so I might have to change the settings while we're talking. But no, Mello was brilliant as always. It's great fun. I treat it more as a social event, really. And it's a great opportunity for me to meet my subscribers to my Substack and swap ideas. And there's some very interesting things I picked up more from chatting to people than the presentations, which was that a couple of guys who are in the sort of institutional space said to me that they're nearly all the incoming inquiries they're now getting for investors, who are interested in putting money into their funds, are family offices in America.
Wow.
Yeah, I thought that was such an interesting point, because somebody else was telling me how, the markets, it's all about capital flows, isn't it? It's not about the fundamentals of each individual company particularly. It's the money just moves in waves in and out broadly of the UK market. And the perception seems to be now that we've passed a tipping point where fund redemptions are still there for some of the smaller mid-cap funds, but that those are now being offset by new money, a lot of which is now apparently coming from America. So, I mean, I haven't got any data to back that up. That's just what I've been told anecdotally, but by people who know what they're talking about. So I think that is really interesting, and that reinforces my conviction that this is more than another bear market rally. I think we're now in a bull market, a new bull market. Could be wrong, but that's my perception.
So after the sort of like the strong 20-25% rally over the past sort of 6 or 7 weeks, then what we're suggesting is that maybe we've actually got further to run if we've got more capital coming into the market, particularly if it's overseas money.
Could be, yeah, could be, couldn't it? I mean, several people, international investors were telling me that the whole Trump thing and the sharp devaluation of the dollar and the extreme volatility in the tech stocks in America has made a lot of global investors rethink their asset allocation. And I mean, we've read things like that in the press as well, but it all seems pretty credible to me that the UK could well now be attracting capital inflows from America, or maybe money that people put into S&P trackers. Some of that maybe is being repatriated back to the UK by eco investors. There just feels a much more bullish tone to UK markets that we haven't really seen for a while. So, yeah, or maybe I'm just believing what I want to believe. I don't know. We'll have to wait for the fund flow data, won't we, to see. You normally post those, don't you, Paul? Have you seen anything on that?
No, I haven't actually. No, but that's really encouraging, because even if it's more towards just the FTSE 100 where there's greater liquidity, it'll actually lift all boats, because what happens is that, as the same with the bond markets, as soon as you get money coming in, it pushes other people on the further edge of the risk spectrum, because effectively, if overseas goes into FTSE 100, then more money then recycles into 250. Then more of that 250 recycles into small caps. So it actually it does lift all boats.
Like a trickle down effect. Yeah, I mean, the only thing I would caveat all this with is that I use a sort of real time market filter on ShareScope. I have it running sort of all day, so I can quickly see with the biggest rises and the biggest fallers in real time. And I am noticing the same sort of names crop up day after day in a lot of the what I would call lower quality small caps that have had huge rallies. People are profit taking now on a lot of those. So I do think we all need to look at it depends on your approach. I mean, you're more just buy and hold forever, aren't you? Which is fine. It's worked brilliantly for you. So I'm not challenging that in any way. But I think most people, even people who think they're investors, are actually traders. They just don't like to admit it to themselves. I noticed that at Mello. People are really bothered about whether they can buy at the exact low and sell at the exact high. And we shouldn't be, should we? No. But Yeah, so I do think there's profit taking. So I think I'm looking at every position in my portfolio and my trading account and say, okay, it's gone up 40%. It's probably high enough now. You know, we thought that, say, for example, with Ramsdens this week, RFX, that's risen about 50%, obviously in sympathy with the takeover bid for H&P, but also Zip just put out a very good trading update, very good results, and brokers have been raising expectations and so on. But we took the view, well, it's now on a PE of 10. A pawnbrokers won't get much higher than a PE of 12, even on at the top of the cycle. So it's probably up with events now. So shares like that, we think, yes, it's still good. But yeah, see that huge rise. It's still good, but it's not stunningly good value anymore. So with that type of share, I think there's something to be said for maybe top slicing, maybe selling half, or just selling all of it and move into something that hasn't moved. I think that's where the opportunities are. But that's what, like I say, that's more for trading rather than investing.
Yeah, no, I think you're exactly right on the valuation, because I think H&T got taken out at 12 times PE, so 10 times, you know, is only is that effectively the takeover premium, isn't it? But what's been sort of is it the same things which have been driving the top and the bottom line, sort of the gold price and Forex and stuff like that?
Yeah, Ramsdens is quite interesting, actually. One of my team wrote a section on it this week, and I didn't realize this. It's got 4 different activities, and they all contribute a fairly similar, even amount of gross margin, you know, gross profit. So if one division, like the gold buying division, as you'd expect, is doing quite well at the moment, and then it's got the pawnbroking side, then it's got the Forex side, and there's a 4th activity, but I can't remember what it is now. But it's a nicely sort of diversified business, we think, Ramsdens. And we've been on about this for a long time, saying how ridiculously cheap it was. So in a way, it's nice to finally see the investment thesis being proven correct. You just have to be patient, don't you, with these things?
No, you're right. Yeah, another one we've got, sort of quite high quality company in the house building sector, which came out with a profit warning, and then the sort of question is this a sort of like a fallen angel? Was Gleeson's, and I know sort of I was just wondering any thoughts on this one, because it seemed to have some land sales which slipped over the period, and plus they've got higher costs. But it's now trading at about 20% discount to net tangible assets.
It is. I mean, this one we've liked a lot over several years, actually. But I must admit, I'm starting to have doubts about it, because it warned on profits on 3rd of June. When was that? That was two days ago, wasn't it? This week, yeah. Quite a. It dropped 22% on the initial news. So I think it's carried on falling a little bit further. And it's one of those things where they blamed. First of all, they started blaming some delayed land disposals, but Dave, one of my team who wrote about this, he pointed out that they used the same reason for missing profit expectations this time last year as well. So they don't seem to have enough visibility over these large lumpy land sales, which is separate from the actual house building activity. But then they went on to say margins were under pressure. They blame planning delays and various other factors. They've done some bulk property sales as well to buy build to rent landlords. So that's becoming increasingly popular. So yeah, so we're a little bit, our confidence is a bit dented in Gleeson, I have to say. But as you correctly say, the main attraction is you've got roughly now a 20% discount to net tangible asset value, and they don't usually go much below that, and unless something really bad goes wrong, like it did at Crest Nicholson, for example. And the outlook at Gleeson does cast doubt on, well, is the house building sector generally under pressure? But the trading up to, so Alan, again, one of my team, he looked at the other house builders, and they're reporting more positively than Gleeson is. So it does look as if there's something company specific here. Over to you, Paul. What's your view?
I was very tempted to buy, actually. As soon as I saw the 20%, I was sort of like thinking, this is a high quality company. Okay, it's gone from it's slipped up over the the last couple of months, etc. Hasn't quite made its numbers, but I'm pretty sure. And I think, is it family owned as well, or it's got some sort of family
I'm
connection?
not sure. The Harwood guys are in this one, aren't they? I'm pretty sure.
Yeah. Yeah, and it's got a good signed balance sheet. You know, if you sort of just a bit of debt, and certainly nothing significant, etc.
That's right. And sorry, Paul, carry on.
It's all affordable homes, so they should be able to sell them. It isn't as though there's a working capital or a de-gearing issue, so they can bide their time. And as long as there's no major industry hit because of the building safety levy, which is going to be announced imminently, as long as there's not that type of hit, then you saw through from Granger's numbers, which is one of the biggest private landlord in the UK, that build to rent for them is going really well. Admittedly, they're more southeast focused and Bristol focused, but even so, it does say to me that everything is healthy. If they get this correct, just tweak their model, they'll they should be back in action. I've actually got quite a lot of exposure anyway into this whole sector through Alico and also through Essensis, and there's a whole bunch of different stuff and Michelmerse obviously. So I'm a bit reticent to push up my sort of like percentage exposure too much. But yeah, I was very tempted actually to buy some shares as soon as I saw that 20% swoon.
Yeah, I mean, the other bull point with Gleeson that I forgot to mention is that it does have a medium-term plan to double the number of houses it builds each year, which is quite interesting. It's got a large land bank as well. Now, if you go for the bigger, more stable house builders, you haven't got the potential for it to double in size. So that's one of the attractions for Gleeson. But I think there is a little bit of question mark over management there, really, because I don't know. Yeah. No, but I think it's certainly one. It's on my watch list as well as a potential buy.
A smaller one. Yeah, I know. A smaller stock in that sector is Watkin Jones, which does the sort of like the purpose-built student accommodation, also does build to rent. It has a reasonably decent balance sheet, net cash, even after the deduction of the sort of cladding provisions. How do you see this one? I think this sort of one of the biggest objectives is to de-gear and to get more money to invest into their land bank. But how do you see it?
We think it's okay. A lot of traders are jumping in and out of this stock, I believe, which I think is why it's volatile. We reported on the H1 results. We did a full section on that, which came out on 29th of May, so quite recently. Now, it dropped sharply, back down 14% on the day, because I think the numbers didn't presumably satisfy the shorter-term traders in it. They mentioned that the backdrop was challenging, but full-year outlook was unchanged. But they did say that was dependent on stronger second-half sales. And as you know, sometimes an H2 weighting can effectively be a deferred profit warning. Yeah, we think the balance sheet's fine, plenty of cash, but about half of that is earmarked for cladding, which of course could get worse. These provisions for cladding do tend to drift upwards rather than downwards, don't they? So overall, we're actually neutral on it. We think it's basically trading at break even. But it's got a big pipeline, and it's large, lumpy contracts. So it's all about the timing of the contracts, and it's interesting. I can see both bull and bear points on it, really. So I'm neutral.
Yeah. No, it wouldn't be my preferred play in the sector, but I think there's more upside potential if they get this model right. If you look at where the shares have come through, whether they ever get back to more than £1, I don't know. But it was trading at sort of 2.50, sort of like 5 or 6 years ago. So the model does work, and again, I think they still have a family connection with Watkin Jones, as in like the family Watkin Jones.
I think they sold most of them at some point a few years ago. But I agree with you. I mean, during the zero interest rate period, the 14-year period, this was a quality business that regular as clockwork churned out, I think, 50 million a year profit or something. I mean, it was really seen as a high quality, secure, safe business model. But that since the interest rates went up, that's the key factor by this. It's never really got back to those levels. So if it does, then you've got a lot of upside, because I think you mentioned there's been no dilution, so same number of shares. So yeah, it could be a multi-bagger.
Yeah, well, we've got lots of questions coming in, which is not a surprise. We've got one from Mr. and Mrs. Greensprouts. They're asking about B&M, which is the value retailer. Used to be an absolute darling. They keep sort of like dripping out sort of like slight profit warnings.
Yeah,
the margins are still very good. What's your sort of latest on this one?
We like this. This reported yesterday, I think, didn't it? Dropped 10% on to £2.97. You're right. I mean, it's quite big. 3.3 billion market cap, 5.5 billion revenues. So this is a big business, a retailer. Makes about a 10%, just over 10% operating margin, which is very good. The stores are quite interesting. They're like giant market stalls, I would describe them as, because they buy opportunistically. They buy cheap lines of products. So you don't have an absolutely fixed product range. It flexes depending on what they can buy. So I'm sure they were probably selling a lot of air fryers, for example, last year and the year before. We think it's a good business, and the long-term track record is fantastic. But as you also correctly point out, they seem to be in a pattern now of slightly disappointing every time they report. As a result of which the shares just seem to have an invisible downward force on them. But at the current level, we think it's very good value. And you get a big yield here. You get 5% normal divvies, 10% yield if you include the special divvies. With the only thing we don't like is a little bit too much debt on the balance sheet, but it's only 1.3 times EBITDA, which is most people would consider fine. Is it one you like, Paul?
I'm not massive an expert. The one question I would have would be, what do their prices on a sort of like-for-like basis compare with the Chinese? So let's just say, for instance, they get a job lot of product they want to shift through their stores on the cheap. They buy it distressed. How does that compare to sort of the really cheap prices on Shein and Temu and places like that? Because 10% operating margins it means their model works really well, no doubt about it. But is that sustainable? I don't know if you've got any feel of that. Is it price competitive?
I don't know on that front. I mean, I'm sure Temu would be much, much cheaper, but I mean, I do an occasional Temu haul, I think it's called, the young people call it.
Yes.
All these environmentally conscious youngsters who preach to us about net zero, apparently they buy a load of junk air freighted in from China on average once a month.
Yeah.
Complete hypocrites. But anyway, whenever I get a haul from Temu, most of it's only fit for landfill. It really is. It's such low quality rubbish product that often doesn't look anything like the pictures. Whereas if you're going to a physical store, to B&M stores, you can pick it up, feel it, touch it, and it's good. So I think that's quite an important point. And you've got no quibble refunds and all that sort of thing. So I think maybe the Shein Temu thing can only go so far. I don't see it as presenting an existential threat to B&M at all. But mystery shop it, Paul, if you haven't already. I don't know if
I hate shopping. I just do everything online. I'm sorry.
Fair enough.
You won't catch me in any of these places, that's for sure. Okay, we've got a question from JKR Investing. He's asking about Dr. Martens, which I think came out with a update of the results this morning, which were in line, and the shares are up, if I'm looking at the correct, 24% on an in-line statement.
Yeah, you're right. From a very low base. Hello, Jacob. Nice to speak to you. I was pleasantly surprised by this. We thought, given that it was such a big mover, we'd have to focus on this one today. So we my colleague Dave wrote up a full section on this, which was published 2 or 3 hours ago on our Substack, and it was better than we expected. I mean, we had Dr. Martens filed in the kind of, it's just junk, forget about it tray. But actually, and I went through the accounts myself as well, just briefly skimmed them, it's really showing significant signs of improvement. The main issue here was that the product's overpriced, poor quality, because it's made in China and it falls apart. The customer reviews are terrible, and they're trying to charge 200 quid a pair for them. So it's been completely screwed up by a private equity ownership, I'm afraid. Financial engineers who came in didn't understand the sector or the strengths of the brands and the products, and have ruined it. And the figures were poor. I mean, this was only marginally profitable. But that's why the shares are where they are. So I think this is a bit of a relief rally. I mean, the market cap's not small. despite that low figure, it's about 700 odd million, I think.
Yeah, that's correct. Yeah, 704.
Yeah.
Yeah.
Yeah, and the outlook statement was for a reasonable improvement in the current year. So I wouldn't say it's value at all, but I do think they have demonstrated clear progress on the destocking. The problem was they had literally warehouses full of boots that they couldn't sell, I think mainly in America. And they have brought the inventories figure significantly down, although it's still massively overstocked. For example, their stock turn, they've got 35 weeks worth of sales in stock. Well, that's crazy. I mean, in my retail days, we used to have a stock turn of 6 weeks. And most of what Doc Martens does is direct to consumer, is through stores and through its own website. Wholesaling is only about a third, the remaining business. So the stock turn should be 12 weeks or less, I would say, and it's at 35 weeks. So they've still got a big problem, which is kind of glossed over in today's results. Also, the cash flow was good. They have reduced inventories a fair bit, and they've used that money to reduce debt. So I'm much happy with the balance sheet. Now it has resolved its debt, and I think it refinanced the bank debt. So I'm actually a lot happier with this. So I was last time I was amber red, which is moderately negative, higher risk type share. We've upped it today to amber, which is just neutral. So I think actually a bounce, it's a lot in percentage terms, but not that much in absolute terms. I think it's probably justified actually, but it's still not a business I would want to own.
Yeah, it's weird really, because when I was a kid, this brand was for skinheads and for their army boots, exactly. And so it was used for sort of like hard working, sort of like boot, etc. But now it sounds like it's £200 for a pair of boots, that it's a luxury product. It's sort of like really crazy what consumer perception, how it can be changed, and then if you're not careful, how it can be damaged as well.
Exactly. This is the big problem. Wasn't it? Back in the day, it was workwear. It was things that builders and mechanics wore on building sites and things. It was hard wearing, tough. But then it became fashionable with the punks and the others, and it's still, still see a lot of youngsters wearing these things, but they can be so fickle, can't they? If a brand just suddenly becomes uncool, you've had it really. Similar sort of thing on a mid-market level compared with Burberry. Their stuff's suddenly got out of fashion, and the profits have vanished. So I generally avoid fashion businesses now for that reason, because you can't predict what the trends are going to be.
Yeah, no, it's tough. Okay, we've got a couple of questions. We've got JA asking about Gooch and Housego, and so is Ben Sharman, which does, it's an expert in all things photonics, particularly for life sciences, for sort of like cosmetic surgery. It does it for the semiconductor space to do with the etching of silicon chips, etc., and for other industrial applications. And then something which is now really sort of motoring is the aerospace and defense, particularly for the sighting mechanisms which go into sort of like tanks, into guns and other sort of firing equipment, laser guided missiles and guns and all this sort of stuff. Anyway, I don't know if you got your latest thoughts. The turnaround does now seem to be happening, but is that a bit premature? Anyway, what are your thoughts?
I think I'm very positive about this. If only I had some spare cash, because I would really like to have bought some of these. We flagged it 3 times this year. In February, it was in inline trading update. On the 8th of April, we flagged it as green, saying this thing looks really cheap, and the turnaround is working. That was when it was £3.93. It's now, last time we looked at it, it was £4.99. That was on the 3rd of June. That was that was this week, wasn't it? H1 results came out. Profit was up 91% to 5.1 million in H1. Order book has increased. They did mention increased execution risks, but I don't know what that related to. And they've got over 95% order cover for the current financial year. So that means there should be very little chance of a profit warning. It's nicely asset backed. It's got a bit of debt, but only 1.3 times EBITDA, which we can live with. So we really like it. We think it ticks all the value boxes, and it seems to have been a laggard well, no, it's had a bit of a rally, hasn't it? But basically, it's still, what is it now, Paul? £5?
£5, yeah.
Yeah, that's a penny different to when we looked at it a couple of days ago. We like it. We think it's well worth people having a proper dig into, because I only do quick overviews. But yeah, do you like? Yeah, I think you like.
I certainly like the area, and I think it's high tech. I'm just not 100% certain about the competitive position. However, they do seem to have got their timing right, because they may have had the deal of the century when they bought an aerospace and defense business just recently, I think at the start of the year, which is just brilliant timing given what's been happening with all the defense reviews, etc. So that should change the mix within the business. So rather than the sort of industrial stroke semiconductor division, which is still suffering a bit, rather than that being the biggest sort of like profit driver, the aerospace and defense will be probably the biggest by revenue as well once you pro forma the new division. So I think they've picked a really good asset, and they've bought it at the right time. So it's definitely what the sort of key metric that I look at is the sort of like the gross margin, and I think it's still about 30%, which just doesn't quite chime with the high value offering that they have, other than suggesting that their competition equally may be Chinese, which clearly couldn't get into the US DOD or anything, or the UK DOD. But it does suggest there is competition even in this high tech type of product.
Yeah, that's interesting, and I think you're right. You're right to highlight the aerospace and defense side of it, because that's something that investors might latch onto and say, well, hang on, all these other stocks have soared, all these other defense stocks that are on very high valuations now. Here's something with defense and aerospace exposure that's dirt cheap. So it could, whether that turns out to be the case or not, doesn't necessarily matter. It's more that investors might perceive that and chase this thing up from £5 up to £6 or £7. So I think this could be a nice trade, actually. But
good point.
I haven't got any spare capacity to buy any personally. But if I had a bit of spare margin, I would buy some.
Yeah. Okay, good. We've got a couple of people asking about ME Group. They are, I can't remember. I'm sorry, apologies.
Oh, it used to be Photo Me.
Basically, and it does the laundrette machines as well. I think, which I think is driving the profits. Shares have rebounded quite a lot from the lows in April. How do you see this one?
Yeah, we like it. I mean, again, this is one of the ones where we're starting to say, well, it's had a great run, like most things have. Do we need to start looking at maybe taking some money off the table here? Not that it's one that I hold, but we reviewed its trading update on Monday, I think, this week, or Tuesday. It was a trading update to April 2025. H1 profits, PBT, are up 14%. So, and as you correctly say, driven by the strong laundry division, which is doing really well. Self-funded rollout of the laundry business. It's a smashing business, actually. And the photo booths side of things, the core business, if you like, was slightly lower. They had some sort of equipment fault, which is being rectified by the supplier, I think. And it's in line for the full year for October 2025. H2 weighting is seasonal, so I don't think we need to be worried about that. And it reiterated PBT guidance between 76 and 80 million. It's a lovely business. It's got net cash as well, pays divvies, and I think it's done buybacks. But like everything, it's had a good run recently. So the readers have to decide for yourself, when you want to bank some profits after a good run. Although we thought overall it's still actually pretty good value. So we're moderately positive, amber green.
It's incredible, isn't it, how a stock you'd think would be fairly sort of like, lacking growth is almost 5-bagged in 5 years.
Yeah,
it's gone from just over 40p to over £2.
Yeah, I mean, one of the signals here that was a very strong signal was it's still owner managed. Serge something, was it? A French guy, I think. And he tried to take it private. He launched a bid. I forget what the price, but I'm thinking, was it something like 80p or 90p? It was, that could be wrong. I'm not sure on that. But that to me was a really bullish signal. If the founder is trying to buy it on the cheap, the prospects are good, don't you? So that was a tremendously bullish signal. yeah, the laundry business has got great potential. There is a little bit of a question mark over photo booths because we still don't really know. They're very concentrated. I think France is the main business, isn't it, on photo booths? Then there's Japan. And the trouble is, will the authorities start accepting pictures from people's iPhones? But I think Me Group are trying to do deals with what do you call it? Tele something or other. Like eyeball looking at your iris.
Oh, see, yes, okay, yeah.
So I think they might actually be embedding themselves deeper into the official ID market.
Yeah. Biometrics, I think you're talking about.
Biometrics, that's it. So that's what I think. That's probably if people are new to this stock, that's a key area I think to research and understand.
Yeah, good. Okay, let's move sector. Let's get into sort of star stock that had a bit of a sort of like a slip up. In fact, it slipped down the whole mountain. I think it was Eagle Eye Solutions, which does sort of like personalized promotional software for the large grocers, the likes of Tesco's. I think does for Asda, a bunch of ones out in Australia and France. And anyway, it unfortunately lost a large US grocer last week, or announced it, about £9 million, high margin as well, through a third party channel, etc. The shares got absolutely clobbered.
They did.
How do you see this one?
I'm rather disappointed with this actually, because this was one of my top 20 share ideas for this year, I think, or it might have been on my runners up list. I can't remember, but I've spoken to management before. I was reasonably comfortable with this share, but it turns out the individual client concentration risk was much higher than really they'd let on. And to be fair, in the risk section of the annual report, it does specifically state we have high dependence on a small number of key clients. And you could argue that it wasn't really their fault that they lost this client, because as you say, it was through a reseller, and the reseller bought a competitor to Eagle Eye, and so has now decided to do it in-house with this client. But yeah, I mean, it's 20% of the entire group's revenue. And as you correctly say, they said it's high margin revenue as well. So this has basically just taken an absolute axe to the forecast. Shore Capital helped us out by issuing a note. And of course, everyone likes to talk about EBITDA, but the damage gets worse the further down the statement you go. And you'll only be halfway there with EBITDA, or not even that. So EBITDA dropped from 13 million to 5 million, but PBT drops from 5 million to 0.
Yeah.
So basically the profits have gone. So I think this is a disaster, I'm afraid. So I'm not tempted to buy any, although at some point people are going to look at it and say, well, hang on, it's now only valued at 60 odd million, which for a business with, very high
really margins.
And really impressive clients, but we thought the clients were really sticky, and here they are. They've lost probably their biggest and most lucrative client. Is it a one-off, or does it mean this business actually isn't as good as we thought it was? Over to you, Paul. What can you answer?
No, you're exactly spot on. I mean, in terms of it will at some point attract sort of value or GARP investors. I mean, I've been sitting on my hands for the last 7 weeks after the debacle at Argentex, just licking my lips. And I've actually just bought some. I haven't bought a big position because I haven't been able to get volume. Because I just think it's a high quality company with. I know what you comments in terms of recurring revenue streams. It inked that deal with SAP to distribute its product to SAP's customer base, which won't move the dial next year in FY26, but should do in 2027, assuming that goes well. And if you get the power of SAP selling their particular promotion, that should make a big difference. And you've got lots of customers there who have been there for 15-20 years. I mean, the first ones they signed was Tesco's, and if you do a search on the internet, they got a big award for, I don't know if you've ever done it, it's Tesco's Challenges promotion. They were the number one sort of like, promotion which helped their Tesco's customers, rather than just giving them discounts. They actually linked it to experiences and challenges that they could do, and it was just quite innovative. So I still think this is I mean, I could be wrong and I could be smoking something, but it just looks too cheap to me. I mean, I was even on a diluted share count, assuming that there's zero price options, etc. If you do it on that zero, on the fully diluted, it's still only now trading at 1.3 times sales, which for a business like this is just, to me, it's just far too cheap. But it all depends, obviously. Is it a one-off? And I treated this contract loss as a one-off, because essentially that partner, as you rightly point out, bought one of Eagle Eye's competitors. So effectively, they were always going to take it out at some point in time.
Yes, yeah, no, very, very, very interesting that you picked up so you've got like a starter size position then?
Yeah, I haven't, but I'll probably add over the next week, depending on what the shares do, and just drip money into it. But I haven't got a full position. I've just got I'd probably say I've got I don't know 1% or something like that of my portfolio. I tend to go for sort of like 5% would be a starter, would be the normal sort of a position size.
Full size. Yeah. Well, I don't know. I'm still shocked really by the announcement, because it was such a bombshell, wasn't it? Because this, I thought, was one of the steadiest, safest type of sticky revenues company. Maybe when the dust has settled, I might dip my toe in as well, because as you say, valuation wise, but I think it might take a bit of time for confidence to rebuild, investor confidence. I think I saw that Canaccord are dumping shares, and they have quite a lot. That's almost certainly Hargreave Hale, who are pretty brutal when they lose confidence in a company and its management. They're gone, so they could absolutely kill the share price if they decide to start dumping. So I don't think I'm quite ready to buy these, but I don't know. I'll have a think.
Yeah, no, I think that's Guy Feld and Eustace Santa Barbara, isn't it, at Hargreave Hale? I presume.
Guy Feld, I remember. Yeah. And they're very, very smart. Yeah.
Okay, let's go down the food chain. Let's go to Chesterfield Special Cylinders. It used to be called Pressure Tech. It sold its sort of oil field parts business for sort of services, parts, etc. About 6 months ago. Paid off the bridging loan it got from its shareholders. Now seems to be focusing on defence, particularly these large cylinders which go into submarines and into other sort of high pressured sort of gas applications, and also has got another potential longer term opportunity in hydrogen. Is also adding on a service line, which is integrity inspection. So once they've actually put these large cylinders into an application to a customer, they'll go and do the servicing of that, and to make sure that it's all safe, sort of like going forward. So I don't know if you had a look at this. It's still very small. But the shares have begun to perk up, actually.
Yeah, they have. We've talked about this before and followed it quite closely, because one of the Harwood team have been very supportive of this company and trying to actively turn it round. And I think it is starting to look as if it's working. I mean, we were amber on this in January and February, and then in March we went up a notch to amber green, on the basis that it got its first hydrogen storage contract win, which, as you say, is a potentially lucrative future use for these big, heavy-duty, high-pressure cylinders, where it's a multi-decade specialist in this area. And then the disposal went through, didn't it, which cleaned up the balance sheet. Anyway, we reviewed the H1 results earlier this week, actually. There were poor figures, loss of 2.1 million in H1, which is very poor. But it was making positive noises about the outlook. It said it's had strong order intake in H1, which is, I think, up to March. And the full year expectations are in line. And the balance sheet's okay now. It's 9 million net tangible asset value, £2 million net cash now, following the disposal of the other division that you mentioned. So it's got a bit of a cash buffer, but it can't afford to continue losing money going forward. It's got to move into profits, I think. And as you say, I mean, I think Britain's just announced an intention to build 20 new submarines, which would be potentially very lucrative for Chesterfield if they got the order. And I'm pretty, you'll know more than me, but I'm pretty sure they're the market leader in this, aren't they?
Yeah, they are. Yeah, and also it's very difficult to get into this market, not only because you have to be certified to get into the MOD and to get into the AUKUS sort of schemes and this sort of stuff, but also actually making really precise large cylinders is a real skill. It's very difficult to copy, because if you just buy something you think is going to work, when it comes under extreme pressure, then it breaks or it cracks, and that's obviously, you know, if it takes a submarine down,
well, that's the thing, isn't it? Yeah, you're not going to quibble over the price and the specification, are you? Because the consequences of one of these things, having metal fatigue or something and exploding, would be total destruction of the submarine, wouldn't it? Without a shadow of a doubt. It's not survivable. Do you know whether they do for the servicing side of it? Do they kind of scan it using ultrasound or something like that for cracks and things like that?
I don't know how they actually do it, but they definitely use technology to assess whether there's actually the integrity is still correct on the cylinder. And these are huge and have to obviously, you know, be able to withstand huge pressures.
Yes.
And therefore the safety, not only on the original build, but also ongoing, is absolutely got to be perfect. And so if you do a one-to-many model on that servicing, that's a good recurring revenue streams. And you could find that 60-70% of this business ultimately comes through just defense.
Yes, I think it's good value. I mean, it's 15 million. Just talk about valuation. It's only valued at 15 million, which, okay, you would say, well, it's a small loss-making business with a poor track record. That's fine. But if you take into account all the other positives that you've just mentioned, you could see this being, you know, maybe a 2, 3, or 4 bagger or something if they land some lucrative contracts. So we think risk reward on this is actually quite good. But you have got to obviously get around that very wide spread and the illiquidity, and there might be a risk of it delisting. That's the other thing. It can't be economically worthwhile having a listing when you're only 15 million market cap, you know. But yeah, I'm positive on it. I think it looks interesting.
You never know; it could do a Filtronic. That would be positive, wouldn't it?
Yeah, it could do. Yeah.
I know. Okay, we've got Toos. He's asking about NWF Group, which I think is an agricultural business, sort of supplies and also sort of like fuel supplies to farmers and stuff like that. I don't know.
That's it. Yeah.
I don't know if you ever had a look at this. Toos was asking about it last week, and unfortunately I forgot to mention it.
Okay. Yeah, I've followed this for donkey's years, Paul. Like most things. The last time we wrote about it was on the 4th of February. On its H1 results, which were in line. It's got a strikingly good balance sheet with net cash. That's the other thing we like about this one. It's good value, basically. Amber green, which is moderately positive. That's all I've got on it. I haven't got any detail here. But
I was looking at the PE, and it's about 9.6. So you're right. It's sort of definitely on the cheap side. Very slim margins, though. We're talking of 1% net profit margins.
Yes, I remember. I spoke to one of the company's advisors about that a few years ago, and they said it's because they have a drop ship model, I think, for the fuel.
Right.
So they make, you know, a penny or 1.5 pence margin, you know, on the fuel, but it's a kind of guaranteed margin. Do you see what I mean? So yes, it is low margin, but I don't think they have the inventory risk either. I've got a feeling. Yeah, it's better than it looks, but that was the upshot. Mind you, a PR company would tell you that, wouldn't they?
Okay, we've got David Raywood. He's asking about Dialight. It says it's just confirmed its new CFO. I think these basically make high performance LEDs and industrial lighting for ruggedized applications, etc. I haven't looked at it for some time, actually, Dialight.
Yeah, I remember in one of your interviews.
Yes,
a couple of the fund managers, was it Edison, were quite bullish on the turnaround here. But I think have you got the price up there, Paul?
It's 102. I'll just bring it up.
Yeah, it's come right back down again, hasn't it? I'm not convinced by this, I have to say. It strikes me as it's been badly run for quite a few years, which I think the fund manager accepted, you know, but was saying, and didn't they have a lot of problems with the actual manufacturing, the actual execution of the Yeah, there was some problem, I think. It's had a lot of problems. The balance sheet's not the best, but it's not dangerous. I haven't looked at it in detail since the end of March, 31st of March, which was, that was it. They had a legal dispute with Sanmina, didn't they? And they got that all agreed, where the creditor compromised with them, which was sensible because this was of a sufficient size to have pulled Dialight down into administration, I think. But that did get resolved. And I think it needs to de-gear. I think it's got too much debt. So it's not for me, this one. I don't want to take unnecessary risks when I can buy clean, cheap companies that don't have all these added complications. So it's not for me, this one. Okay. It doesn't sound like you're interested either, Paul.
No, I've never really been to get my head around the IPR associated with it, other than just choosing the right sort of suppliers and then basically fitting the application to the, basically the customer base. And I don't know what service revenues it is either. So it wouldn't be something I would jump into. We've got Richard Leppington. He's asking about CMC Markets, which I think came out with I don't know if it was a little profit warning or whether it was actually just an inline statement that didn't really meant there was a bit of profit taking. How did you see it today?
Well, it's always difficult where we can't get hold of broker notes. So what I think it was this morning. That's right. Yeah,
it was. Morning. Yeah, shares are off 13%.
They are. Well, I interpreted it first. This was difficult because we put up the first draft of our reports before the market opens, so we have to kind of make a guess almost on this. So I said here, this was results for year ending March 25. I said that they're good results. Profit was up 33% to 84.5 million. But then I checked on ShareScope what the forecast consensus was. And the consensus was 10 million higher, 95 million. So it looks like a 10 million pound profit miss, but I can't be sure on that because sometimes the brokers adjust things in or out, so I'm not 100% sure that I'm comparing apples with apples there. So good numbers, but it does look to be about 10% below expectations. So, and then the share price move subsequently, as you say, about 13 or 14% drop, kind of ties in with it about being about 10% behind expectations, doesn't it? Although it said recent trading was supportive of the forecast, and it said it has good momentum going into the March 2026 year. And of course, market volatility helps these type of companies. It's the other notable thing that I really like about CMC Markets is the balance sheet. It's immensely strong. You've got where is it? You've got almost half the market cap. Actually, it'll be over half now. Is net tangible assets, and the biggest one is cash. So it's got 240 million of cash. So that we originally went into this at £1 a share when you were getting the business literally for nothing. You were literally just buying the working capital. It was a stunning bargain at £1 a share. Not that much of a bargain now. I think it's pretty good actually, but I think the market has done the correct move today to about £2.50. I think it's I'm moderately positive, amber green. So have you looked at it, Paul?
I did, yeah. They basically said that they're moving into crypto, didn't they, as their third sort of growth drive. I'm not sure how successful that's going to be, but hey, if they believe that it's, I absolutely love the business to business sort of like opportunity where they white label their platform into other sort of like, financial services companies. That makes a lot of sense. And their B2C is competitive, but you're right, will benefit from the volatility. I'm just not sure how competitive crypto is, and also, in terms of ups and downs. But hey, it's still cheap. We're talking only 10 times PE, so we're not paying much for a potentially a good growth engine there.
Yeah, you're right, and with all that asset backing as well, providing some level of floor under it. I think people got excited a little while ago, didn't they, about them teaming up with Revolut and one of these other challenger banks,
Yeah,
but
that's right.
I wouldn't personally have thought that Revolut accounts would necessarily bring that much new business to CMC. I don't know. Have they given any indication of what volumes are going through those new channels?
I haven't looked actually. I'll have to run through the detail. Okay, good. Let's move to, we've got Steve Walters and we've got Rising Bull, both asking about Ashtead Technologies, which is basically an oil and gas services business, but also does renewable services, submarine sort of stuff, offshore, around the world actually. It looks as though the shares have really, I guess, has really sort of like sold off because of the oil price or worries about it. But I was just looking at the year-to-date performance; it's 24% down, which is, I guess, is this an opportunity because it used to be a real darling.
Yeah, that's a really good summary, Paul. Yeah, absolutely spot on. I mean, this was a real fashionable growth stock a couple of years ago, wasn't it? And it went up to a really high valuation. So obviously, as a value-leaning investor, it wasn't of any interest to me at all back then. But it started to come on my radar, actually. I was amber on it in January and March, which I think the January trading update was ahead of expectations, and the PE dropped to 13.6 times, which, you know, for an equipment hire business is probably about right. So I thought, okay, amber. But then I moved up to amber green recently, actually on the 22nd of May, where it said it was in line for the first 4 months of the current year, record key customer backlogs, and targeting a move from AIM to the main market this year. Unchanged, so in line with expectations, broker unchanged. The only thing I don't like about Ashtead is the balance sheet. It does have a bit too much debt. Debt's 1.85 times. But we've basically, both myself and my colleague John, looked at this and we agreed the shares have halved, and I can't remember over what period that is, but we now think it's reasonable value. So yeah, we think this is a good time to be having a proper look at Ashtead Technologies. Are you convinced, Paul?
Sorry, can you hear me, Paul?
It froze briefly then.
We did. You're right. Anyway, I was just looking at the PE ratio, and it was 9.7 I've got for this year.
Yeah, it's not bad, is it? I mean, that I'd add a bit onto that for the debt, but have you researched it, Paul?
Yeah, I like it. Like you, I think it's a good quality business, and I think it's more defensive than just the oil price. It isn't just a total dependent on it. So yeah, it's certainly something I would have a good serious look at it now that it's really in quite deep value territory.
Better value, yeah, I completely agree. Yeah, definitely.
Yeah. Okay, good. Let's. We've got a question actually from Paul Bennett asking you, Paul. He's asking, what's your longest holded stock you've held, or currently in your portfolio, and what's been your best performer of all time?
Oh, crumbs. Well, I mean, I'm just fairly what's the word? Easygoing about holding periods. If I think something, I was chatting to somebody last night at Mello about this. I don't look to have a particular exit point from a share in terms of time. It's just all down to value. If something just goes nowhere or drifts down, I'll eventually get bored and sell it and buy something more interesting. But if it's doing what I thought it would do and the valuation's still reasonable, I'll sort of hold things open-ended. So I mean, historically I've held things for many years, 3, 4, 5, 6, 7 years sometimes, if the story is intact. Currently, I think probably the longest held position that I've got at the moment is Plexus, which I've held for about 2 years, I think, and it's not going anywhere. I'm just in for, I've kind of parked that separately to the rest of my portfolio. I'm just in for the duration because I think the potential upside on it is so interesting. I'm not really bothered what the short-term share price is. So that's a long-term position that I'm not going to touch. So that's more a Paul Hill type position for me. But then, the rest of the stuff in my portfolio, probably I'd like to see something happen within a year. If it just nothing happens, and then I'd probably ditch it simply because something better will come up. So for me, selling is more about what new opportunities I'm spotting and where the money needs to come from. So I just periodically cull the bottom end of my portfolio where I've just maybe lost a bit of confidence in the bull case, or maybe if outlook statements are a bit vague or the tone has changed. Those are the sorts of things that will probably drive my selling decisions rather than time.
Yeah. Good. Okay.
How about you, Paul? I'd be interested.
Yeah, I mean, my sort of the biggest winners so far are probably the ones which have held the longest. So my top one was Equals. I held for 5 years. Crestchick I held for about 6 or 7 years. Alico, which I currently own, is 10 years. I used to own Regenesis and then Blanco for about 7 or 8 years, and those are the sort of the big winners I've had. There's another OGN as well, actually, which was a hazardous waste business that got taken out. But I owned that for about 5 or 6 years as well. So it tends to be that type of period that makes the biggest profits. Being patient.
Right. You're right. I know. Lesson for the day from Mr. Hill is run your winners.
Well, I don't always run them, that's for sure. But
you're right. It does. If you pick well and you run them, it does make a huge difference, doesn't it? Yeah.
Okay, good. Let's go to a little tiddler. Actually, we have talked about it, I think, in January. It's called Cordel Group. Basically, they do lidar systems for rail condition monitoring and servicing. So they stick basically a high performance camera, lidar camera, on the front of a train, and then that then surveys the vegetation, the track condition, also the bridges conditions, and then they do an AI engine on top of it to automatically pinpoint to the owner of that track, the railway, what maintenance and improvements need to be done. It's won just a big contract out in the States on top of one it already won with Amtrak. I don't think it's profitable yet, but it certainly seems to be moving in that direction.
I think this looks interesting, actually. I've covered it twice this year, and I should disclose, actually, I recently bought a small starter position in this. Not a big amount, just dip my toe in so that I follow the story more closely, and then I can either ditch them or add to them once I've followed it for a few months. I flagged it originally in January this year. 22nd of January, I did a write-up on it on my Substack for the interim results. And basically I quite liked it. I concluded amber green, which is moderately positive, but then I put in brackets speculative to, warn people that it's not a value share as such. So what caught my eye though was that the H1 loss greatly reduced, and it only lost 253 grand in H1. So it's bearing down on profitability. And it promised a big uplift in H2 revenues. Now, usually with these type of small loss-making companies, you have to watch the balance sheet like a hawk. But I concluded in January that the cash was a bit tight, but just about okay, were the words I use. Then more recently, to bring it up to date, on the 2nd of June, so early this week, it rose 13% on a contract win, which you were quite correct about. Now, what interests me is this is a tiny little UK company, probably only got a handful of staff, but it's winning contracts all over the world. I think some of them are pilots, though, so we need to be a bit careful about that. But it's just announced a new 5-year contract with an American railroad, freight railroad, because I think the operators own the tracks in some cases in America, don't they?
Yes, they do. Yeah.
So now it's a $7.5 million contract over 5 years. So what's that? £1.2 million, £1.1 million per annum. But it's split into two. I didn't quite understand what the split was. Cavendish said this underpins, to use their word, unchanged forecast. So it was in the forecast already, this contract win. Balance sheet's just about okay. It's got £1 million net cash. I think it's speculative, but it looks to me like a credible growth company that's winning sensible contracts in multiple countries. So it's probably not going to, it's not going to be Microsoft or anything, is it, on that, or Google on that scale, but it's only 15 million market cap. If this then tips into profit, you could see that being maybe a 2 or 3 bagger if they get continued momentum. I like little companies that start winning big contracts. That's one of my favorite investing themes. And this seems to be ticking that box. So, over to you, Paul. Have you looked at this one?
Yeah, no, I like it. I actually think it's going to get taken out at some point in time, whether it's like Siemens Rail or whether it's even Traxys. They need, if that technology was housed within a bigger business that services more sort of rail customers
Oh,
around
yes.
the world.
Yes,
It
good
would be
point.
then a one to many, and clearly it works because they've won some contracts with some really big players. They just need to scale it, and at sort of like market cap of 15 million. I mean, it's just a small bite, really. So
Yeah.
I wouldn't be surprised if somebody put a rule over these in the next 12 months.
I don't suppose you've got to hand what the shareholder list looks like, do you, Paul? Is it fragmented, or is it controlled by anyone in particular?
Let's have a look.
I don't know if we've got found.
Great question. The major shareholders. Here we go. Yeah, there's Nicholas Scott, who owns 12%, and then there's another individual investor, Aaron Hoyle, as well, owns 12%. Rathbones, Maven Capital. Yeah, so
Rathbones, I've just reminded me. Now it's interesting they're in something this small.
Yes.
They're a huge fund. I have a feeling they might have done a top-up placing for Cordel maybe last year on quite favorable terms. I have a feeling.
Yes.
I think it was that they wanted to buy a stake, couldn't buy any in the market, so they approached the company and said, "Well, issue us with £1 million of shares, and we'll pay, above the market price." I think that was this company, and I took that as a very bullish signal.
Yeah.
If you've got a friend of mine works at Rathbones, and he said they're a really impressive outfit. They know what they're doing, so could be quite interesting, this one, couldn't it?
Yeah, it is. Yeah, no, it is. I mean, I think you say liquidity. If Rathbones struggle to get in, everybody else, if you want to put a big number on it, you're going to struggle. But if you just want to put 10, 15, 20 grand in, it shouldn't be a problem, I wouldn't have thought.
Yeah, I did. I only bought a small position myself, but I had to break it up into 3 small clips.
Yeah.
To get the trades through, so it's so for a man of your means, it won't be of any interest at all, because you won't be able to.
Well, I own Traxys, so but I could see absolutely the synergies for somebody like Traxys to buy them. That'd make a lot of sense.
Traxys don't overpay, so as a Cordel shareholder, I'm not too keen on Traxys sniffing around it. Talking about it, your purchase of Traxys was absolutely inspired a couple of months ago, wasn't it? It's about 50% up.
Yeah, well, let's wait and see what it's like in about the other year's time.
Okay.
I'm not banking those profits yet. We got Lizar is asking about VP Group, equipment hire in sort of all things construction, largely in the UK. Has some testing businesses as well overseas. Does largely it competes a bit with Speedy Hire, but most of its businesses are really quite specialist, things like trench supports and all this sort of stuff into the infrastructure sector. Shares are reasonably cheap at £5.84. Anyway, what's your thoughts on on VP?
I've always liked it, actually, Paul. I should probably get this. Yeah, I think it's good. It's up about 20% from when I last looked at it, which was mid-April, when it was £5.10. And I took the view there. It was a resilient performance, inline update, mixed outlook statements, and decent enough balance sheet. There is some debt, but you'd expect that at an equipment hire business. I thought it was good value at £5.10. So I'm not sure it'll be quite such good value now. I think this one. Didn't you write a research when you were an analyst?
Yeah, I think this is the equipment stock to go for in that whole sector. Plant hire, etc. I was just looking at the valuation. I mean, it trades at about 8.6 times PE. Now, in terms of EBITDA, I've got a sneak suspicion it's something like sort of 4 or 5 times EBIT, sort of EBITDA or something, which is really dirt cheap. It's still controlled by, the Pilkington family, who own just over 50%. But no, I think it's a high quality business, always very well run. And it doesn't lose scaffolding or anything like that.
Yes. Well, I think that's jogged my memory about the owner manager who owns 50. I think, as you say, 51%. They were trying to sell the business several years ago, weren't they? And I don't think they got any offers that were acceptable. But it's basically, I think, an interesting special situation where part of the reason I think you'd want to own this share is that one morning you'll wake up and they'll say, oh, we've sold it to a large US group for a 45% premium or something. You know, they're not going to sell it cheap, are they? Where you've got a 51% shareholder that actively, yes, would sell if they could get the right price. That's the perfect setup, I think, because you're not going to get it whipped away from you on the cheap. But so I like VP. I've never bought. I think I might have held it briefly, and it was horribly difficult to trade in and out of because I think the share register is so concentrated. There's not much free float. That's the only problem with it, really.
Yeah. Okay. Good. Perhaps the last question we've got. Who was it? Somebody was asking about VP Group, not VP Group. Sorry, that's wrong. What was it? Oh yeah, hVivo. I don't think, which is basically the challenge trials business. This is who was asking about that one? Oh, I can't remember. Sorry, apologies who wants it. But anyway, they came out with a profit warning due to essentially a lot of the biotech businesses being hit out in the States, that they then reduced their the amount of infectious diseases, vaccines and medicines they were testing, and some of those then got taken out of hVivo's contract order book, etc. Led to quite a tough sort of like profit reset last week. Anyway, what's your latest views on this one?
Well, this was the second profit warning this year. hVivo warned on the 29th of January, and some of my readers did actually say at the time, look, we should have foreseen this, because the human trials market in America apparently was seizing up. There's some competitors over there saying that the drug companies, the pharma companies, were just pausing development because of all the upset, a lot of it, the political upset from Trump. So maybe that was in the back of my mind and was a reason why I didn't buy any. But I was quite close to buying when it got down to 15, 16p. So it was, I dodged a bullet here more through luck than judgment. This profit warning was seriously bad. I mean, this was 30th of May. Really bad. I mean, it was going to make, consensus was a 9.6 million operating profit. They're now saying they're going to make a loss of 5 million. So for me personally, and people will hate me for saying this, but I feel it's blown the business model out of the water, because we now know that this thing is so highly dependent on large lumpy contracts, which can be cancelled on a whim. But you see, the company is being putting very bullish, a little bit too bullish, director comments out saying they've got the largest ever sales pipeline. And then I don't know if you spotted the director buys. Yes. Reasonable sized director buys on the 2nd of June, but they actually put a PR release within the RNS where they gave a little spiel about why they're so. It was to, quote, demonstrate our continued confidence in the growth prospects of the group, end quote. And they carried on in that vein. Well, I don't think I've seen that before, where, a director by RNS is just a factual thing. These directors have bought this, to then get a PR statement attached to it. I think they probably started a trend. I think you'll start seeing that with all director buys.
Yeah, I mean, it's difficult to a certain extent. The market is tough, no doubt about it, but that will change. I mean, let's be clear about it. Vaccines work. We've shown, like, from sort of like, and antivirals, like from penicillin and stuff. So from your from your colds to your sort of like your MMR to your COVID vaccine, they work, and there's going to be more sort of like research going into it ultimately. It's just if we've had a bit of a reset with Trump and the guy, that Kennedy chap they've put into the top of the health. So I personally would look at it as a glass is half full. I mean, if anything, I would be buying alongside with the directors on this one, because I just think there aren't that, it isn't easy to get into, be able to do challenge trials with regulatory, approvals required. And given that the shares have been absolutely blasted, they just look far too cheap to me. But hey,
Yeah, well, I remember on the day of the profit warning, it was down 58% to, I think it dropped as low as about 6.75 pence.
Yeah, yeah.
And I started to look at this and think, well, at what point does it become value? And you
Mm,
see the last accounts at December 24 showed net cash of 44 million. So
yeah.
it got down to a point where it wasn't far above its own net cash. So
Mm.
I was umming and erring about this. And I remember I went mid-morning, I went back, I was in Alderney, and I'd been out on the tiles the night before with the locals. Boy, they can drink in Alderney. Oh, blimey. So anyway, I was having a nap I got the morning report done. I was having a nap, and I was thinking about whether to buy the dip. But by the time I woke up at lunchtime, it had gone from 6.75 pence to about 9.5 pence.
Yeah.
So it just shows that that's actually quite an interesting point. One of the reasons I think we might be in a new bull market now, you are starting with some companies to see quite strong rebounds on profit warnings, whereas over the last 2 or 3 years, it's generally been profit warning straight down and just continues drifting down, doesn't it? So I don't know. I mean, you're quite right, though. It's either glass half full or glass half empty with hVivo, isn't it?
Yeah. Good.
I'm unsure, so I don't know on that one.
Yeah. Good. We'll have one final question. We've got Adrian Demade. He's asking about Wise that came out with. They're basically the international payments business, which has, I think, decided now it's got a primary listing. It had its primary listing in the UK and now decided, actually, I'm going to put a US listing on it. Shares have responded pretty positively, actually, today, because I think it's going to be a re-rating. I don't know whether you had a quick look at this. I think it was up, was it 7 or 8% today? Maybe even more.
Yeah, we love it. We think this looks really exciting, actually. I mean, I'm not even remotely qualified to analyze this, but I mean, it's highly profitable, and it's got the it only books 1% of the interest income, doesn't it? And then
yes, that's right,
underlying, and then it puts a whacking great figure that's multiple sizes that further down the P&L.
Yeah,
and I think again, it was I think you've spoken to two experts on this, haven't you?
Yes.
Who've all said this is a business that could scale up 10, 15 times. I think your guy, you've been
Jamie Ward said he's. I mean, this is a guy who was an ex-fund manager, professional investor.
Brilliant that interview. Everyone should listen to that. It was fascinating. Sorry, carry on.
Yeah, well, this is his biggest position. I think he's got about over 30% of his portfolio in just this one stock, and he's going to hold it forever because he just believes that it's killing the likes of, sort of the banks in terms of international payments.
Yeah, I mean, I'm not qualified to judge, but I think it's a very compelling story, actually. And we were in our chat room, me and my team were discussing this morning, and we all agreed we should just buy some of these and just hold them forever. It's probably unique in terms of the UK market, and as your Jamie was it, as he said, in America, they wouldn't bat an eyelid at paying 80 or 90 billion for this business, and it's valued at 11 billion in the UK. Having said that, though, there'll be American investors who bought shares in London, won't there? So listing it in America won't necessarily, it's not like it's going to be introducing it to American investors for the first time, is it?
Yeah.
But, well, I mean, look, the numbers today were superb. Yes, you're having to pay quite a high multiple for it, but they're talking about trillions and trillions in potential market share. And as your guy was saying, they're not trying to squeeze the customers to profit maximize, which is one set of businesses, which is most businesses. They're doing the opposite, like Amazon Web Services did. They just keep lowering the price, hoovering up more and more market share until there's no competition left. And I think that's and then they could ultimately offer the service free. And just earn interest on an absolutely vast, fast churning customer float of cash. I think it's really interesting.
Yeah, no, you're right. Actually,
you're the guru on payments companies, Paul.
Yeah, I mean, it's great. I'm a bit sort of bruised and battered. I think like you at the moment, it would take me a big leap of faith to buy anything payments related, given what happened with Argentina. But actually, one stock I'd be remiss of me not to talk about just quickly is Wizzair, which is something owned by a lot of private investors, down 25% today. It's got a number of big problems. It does low cost air airline flights to the Baltic states, but also to Ukraine, which is obviously pretty slow at the moment, in fact, not much, and Israel and Gaza, that's obviously closed, and then has got a problem with its engines on its Airbus planes, because Pratt & Whitney have had a real safety issue that they're having to swap out and get them a lot to repaired. Shares, I say, are down 26%. Is there a point when this becomes value territory?
No, I don't think so. I wrote a section on this morning. I've never been positive on this, and I'll tell you why. It's because it's erratic performance from the company. It always seems to lag EasyJet and Jet2.com and Ryanair. But the big issue with Wizz Air is its balance sheet. There's nothing on the balance sheet. It's if you take off the intangible assets and the deferred tax asset, its net tangible asset value is actually negative. So it's got massive debt. More of the planes are leased than owned. It does own about 1.5 billion of planes, but it leases 2.8 billion of right of use asset value. Horrible balance sheet. So you've got nothing in reserve if there's another, say, pandemic or volcanic ash cloud. Do you know what I mean? It's got no financial buffer. And I think if the pandemic taught us anything, it's that if you're an airline or a holiday company, you need to be sitting on pots of cash, own company cash, and I think when you can buy Jet2.com, Ryanair, EasyJet, and even IAG on single-digit PEs with bulletproof balance sheets, why on earth would you even consider this? So no, I think I've dropped my view from amber to amber red, because I think risk reward on Wizz Air is very poor.
Yeah. Do they own any landing slots at all that could be sold if they ever got into difficulty? I mean, obviously,
I don't know.
Yeah. It just seemed, I mean, it's sort of like 5.5 times PE, 4 times EBITDA. It does look cheap, but you're right.
I'd be careful with the PE though, Paul, because again, they hid the PBT number today. They highlighted on EBITDA and operating profit. But of course, because it's got so much debt, there's a massive finance, 145 million euros, I think, finance charge. So PBT was only 20 million euros for the year. So and then there was a large tax rebate, which of course heavily boosts EPS. So therefore the PE number will not be reliable. So I think ignore earnings per share on this, or normalize the tax. And it was just a deferred tax calculation, which of course is a load of nonsense. Deferred taxes, I just ignore it. So I think the numbers are pretty flaky, actually. So I would say no, it's not cheap. It basically operated at break even in the last year. The engine issue, as you say, did drag them back. They've got planes just sitting around that they can't use. But I think it's a low quality business. I wouldn't touch it.
Yeah, well, no, I think I'll take those comments to heart, because it isn't the kind of business that I would buy either. But anyway, all right then. Thanks very much, everyone, for your questions. Apologies, I haven't been able to get to everyone's, but if you hold them, then we can put them into to next week's show. And thanks again, Paul, for marvelous insights. And look forward in touching base 2:00 next Thursday for another small cap show.
Great, thanks, Paul. Very stimulating and enjoyable as always. I love doing these; they're fun, aren't they?
Good.
Great.